Chapter 12, Part 1, we're going to talk about investing in other companies. And the first way we're going to talk about is investing in other companies' bonds. And we categorize those as trading, available for sale, or held to maturity. Now, normally we can invest in two ways. We can either buy another company's stock or we can buy debt securities, such as bonds or notes. Purchased by individuals, our concern is corporations, and the objective is to earn a return from dividends or interest the securities pay or from increases in the market value of the securities. And the other reason we would buy another company's stock would be to develop ongoing affiliations, like for instance if they have a product we like or they have technology that we want to acquire. That's why we do this. Now, there are critical events that occur when you make an investment in another company's bonds or stock. First, you have to record when you buy them. You have to recognize investment revenue. For debt, it's interest. For equity, it's dividends. Then, during the period you hold it, depending on what it is, you may have unrealized holding gains and losses. And then when you sell it. Now we're talking about debt instruments, and here we have three types. Held to maturity, which means you have both the ability and the intent to hold until they mature, so you do not recognize any unrealized gains or losses, and all you do is amortize any premium or discount. Trading securities are very shortly held. Any unrealized gains or losses are recognized in income, and they're always shown at fair value. Available for sale debt, which means you're going to hold it for longer than 3 months. Here we recognize in other comprehensive income any unrealized gains or losses, and then when we actually sell them, we are then going to take this off the books and book the actual gain or loss. And these are always shown at fair value. So, key difference among the reporting approaches is how we account for unrealized holding gains or losses on debt that we purchase. So now let's look at some examples. Now, example 1, we have purchased bonds that pay 6%. They have a face of $240 million, and we paid $280 million for them. The bonds provide the bondholders with a 4% yield. The company uses the effective interest rate to allocate unamortized discount or premium, and the bonds pay on June 30th and December 31st of each year. So, the intent is to hold them. And at the end of the year, they have a fair value of $270. Now, what's our journal entry when we buy them? And that was July 1st. What is it at the end of the year? How would it appear on the balance sheet? And what if the bond rating agency changed the risk rating on the bonds and the company decided to sell instead? Now, what information do you need to solve the problem? First of all, you need to know how much did you pay for it, because that's what we're going to credit cash for. Then we need to know what's the face of the bond. That's how much we're going to receive at the end of the term. That's going to be the debit to investment in bonds. The stated rate, this is used to determine the cash received for interest revenue. Then we're going to determine if it was purchased at a premium or discount. We paid $280, the face was $240, which means we paid $40 million, then the face, which means we paid a premium for these bonds. When is interest received? Semi-annually. And if using the effective rate, what is the yield? In this case, it's 4%. This is the rate you use to determine the interest revenue. Now we can do our journal entries. We book our cash, our investment in bonds, and the difference is going to be the premium on bonds payable. Now, our end-of-year journal. The cash is before the interest is going to be the face of the bond times the stated rate divided by 2. We pay semi-annually. The interest revenue is going to be the net book value of the bonds in this case, times the effective rate divided by 2. That tells us our interest revenue. And now we have our premium on bonds, which is the difference. And we ignore fair market value if held to maturity. Now, what amount would appear on the balance sheet? It would be $278,400,000. And we have already written down 6 months of the amortization, so that reduced our premium. And again, we ignore fair market value. Now, what happens when we actually sell them? Well, we're going to book the cash. We're going to take the balance and the premium on bonds off the books. We're going to take the investment in bonds off the books. And then, depending on whether we need debit or credit, in this case, we had a gain on sale of $11,600,000. So in this case, we recognize no gain or loss until we actually sell the bonds. Now, what happens if instead these had been trading securities? We're going to go through and do all the same journal entries. So our first entry is exactly the same. We're going to book the investment in bonds, which is the face of the bonds. The cash is how much cash we received. The difference is premium on bonds. Then we're going to book our interest. Again, the cash is always going to be the face of the band times the stated rate divided by 2 since it's semi-annual. Interest revenue is going to be the net book value of the bonds times the effective rate divided by 2. And the difference will be premium on bonds. Now we have to adjust to fair market value. Fair value is $270 minus the net book value, which is going to be $280 million minus 1.6 that we amortized on our December 31st journal. And that tells us we're going to have to adjust it by $8.4 million. We're going to have to reduce it. So, unrealized loss on investment, net income, this goes to net income, and fair value adjustment would be 8.4. Now, what would appear on the balance sheet? The $270 million. Now, what happens if we sold it? First of all, we have to update the fair value amount. What we're saying here is the fair value adjustment is $11,600. We have to determine the amount to book for the fair value adjustment. So the balance has to equal the credit balance plus a number which will give us a debit of $11,600. And we get $20 million. So fair value adjustment is going to be $20 million, and gain on investment unrealized in net income is going to appear as $20 million. Now, what's our journal entry going to look like when we sell it? So first, we're going to book the cash received. We're going to take the investment off the books. We're going to take the premium on bonds off the books. And we're going to take the fair value adjustment. If you notice, we're not booking any gain at this point like we did with held to maturity, because it assumes we recognize the gain during the period we hold them. Now let's look at available for sale. Now, same problem, except now we're saying that these are treated as available for sale securities. We've got the same questions we have to answer. Now this journal entry is going to be the same, and so is this. So the booking of the purchase and the journal entry for the interest will be the same. So will the adjustment to fair market value, at least the amount, except that in this case the unrealized loss is going to go to other comprehensive income and fair value adjustment. Now, what would appear on the balance sheet? $270 million, which is the fair value at the end of the year. Now, what happens when you sell it? Well, you have to update the fair value account again. So you're going to go fair value adjustment, gain on investment, unrealized, other comprehensive income. Now when you actually sell it, what you have to do first is reclassify the fair value adjustment, which means you've got to take it off the books. Then what you're going to do when you actually sell it, that is when you're going to recognize the gain on sale investments. So for held to maturity and available for sale, you're not really recognizing the gain on the income statement until you actually sell it. And that ends this presentation.